Let me tell you about a mistake so common and so costly that it happens in the majority of American families, and almost nobody sees it coming, because on paper, everything looks handled. Robert did everything right. He was careful and responsible, the kind of man who plans ahead. He went to a lawyer, paid good money, and had a proper will drawn up. In that will, he left everything to his current wife Linda, whom he adored, and to their 2 children. He signed it, felt the relief of a job well done, put it in a drawer and never thought about it again. 20 years later, Robert passed away, confident his wishes were locked in tight. And then Linda got the news that his largest asset, his $400,000 401k, the bulk of their retirement savings, was not going to her at all. It was going to his first wife, his ex-wife, a woman he'd divorced 25 years earlier, because decades ago, when he first opened that account, he'd named her as the beneficiary, and he never changed the form. And here's the part that Linda could not believe, that made her feel like the ground had opened up. It didn't matter one bit what Robert's will said. The will left everything to her, and it was powerless. The ex-wife got the $400,000 legally, and there was absolutely nothing anyone could do about it. How is that possible? How can a legal will drawn up by a lawyer be completely overridden? That is exactly what we're going to unravel today, because it is one of the most important and least understood truths in all of retirement planning. Your will does not control your retirement accounts. Not your 401k, not your IRA. Often the biggest money you have. And if you're relying on your will to protect that money for the people you love, you may have a hole in your plan the size of your entire nest egg and not even know it. So here's what I'm going to do. First, I'll explain exactly why your will has no power over these accounts, the simple mechanism behind it, in plain English. Then I'll show you what actually does control them and how to make sure the right people inherit. And then, because this is the part almost no one tells you, I'll show you that naming the right person is only half the battle, because the rules for how your heirs can inherit that money changed dramatically a few years ago, and a mistake here can hand a big chunk of your savings straight to the IRS. By the end, you'll know exactly how to protect the largest accounts you own. Let me give you a couple to follow. We'll use Robert and Linda's family to see how this should have gone. Let's dig in. First, the core truth, the one that explains Robert's disaster. Your assets actually pass to your heirs through 2 completely separate channels, and most people only know about one of them. The first channel is your will. Your will controls what we call your probate assets, things like your house if it's only in your name, your car, your personal belongings, your bank accounts that don't have anything else attached to them. When you die, these go through that court process called probate, and the will is the instruction manual the court follows. So far, so familiar. This is what everyone pictures when they think about inheritance. But there's a second channel running completely parallel to the first, and it's the one that catches people. A whole category of your assets does not pass through your will at all. Instead, they pass by something called a beneficiary designation, a form attached to the account itself that names who gets it. And this category includes some of your most valuable things: your 401k, your IRA, your other retirement accounts, your life insurance, your annuities, and any bank or brokerage account marked payable on death. On every one of these, there's a named beneficiary, and that named beneficiary is a legal contract between you and the financial company. When you die, that company is legally obligated to pay the money to whoever is named on that form, and to hand it over directly, skipping the will and skipping probate entirely. Now here is the crucial part, the part that undid Robert. When your will says one thing and your beneficiary form says another, the beneficiary form wins. Every time. The beneficiary designation is not overruled by your will. It overrules your will. Your will could say, in the clearest possible language, I leave my 401k to my beloved wife Linda, and it makes no difference at all, because that account was never controlled by the will in the first place. It's controlled by the form. Robert's form said his ex-wife. So his ex-wife inherited, and his will was just a piece of paper with wishes on it that the law had no obligation to honor for that account. Let me make sure this really lands, because it is the whole point of today. For most retirees, their retirement accounts and life insurance are the largest assets they own, often far bigger than the house, far bigger than the bank account, which means the majority of your wealth may be passing through that second channel, the beneficiary channel, completely outside your will. So you could have the most beautiful, expensive, perfectly drafted will in the world, and it might be controlling only a small fraction of your actual money. The big money marches to a different set of orders, entirely. And this is not a rare freak accident. Remember, only about 1 in 5 families has actually updated their beneficiary designations. Think about how many old accounts are out there right now. Naming ex-spouses, naming people who have died, or naming no one at all. Every one of those is a Robert and Linda disaster waiting to happen. So let me show you how to make sure it never happens to your family. What actually protects your retirement accounts is the beneficiary designation itself, so the entire game is making sure that form is filled out correct and current. This is the thing that actually does the job your will cannot. Let me give you the specific steps. Step 1. Find out who's actually named on every single account. And I mean actually check. Don't assume. Contact each financial company or log into each account online and look at the named beneficiary with your own eyes. Do this for every retirement account, every old 401k from a job you left decades ago, every IRA, every life insurance policy. People are genuinely shocked by what they find. Accounts they forgot they had, names they don't remember choosing, ex-spouses still sitting there. This one afternoon of detective work is the single most valuable thing in this entire video. If Robert had done it just once in 20 years, his story ends completely differently. Step 2. Name a primary beneficiary and, this is important, always name a contingent or backup beneficiary. The primary is your first choice. Say your spouse. The contingent is who gets it if the primary has already passed away. Why does this matter so much? Because if your only named beneficiary dies before you or with you, and there's no backup, the account often falls back into your estate, which drags it into probate and, as we'll see in a moment, can wreck the tax treatment for your heirs. Naming a contingent beneficiary is a free, 30-second insurance policy against that. So many people leave that second line blank, and it causes enormous problems. Step 3. And this is a subtle, one that prevents a lot of family heartache. Consider how the money splits if one of your children dies before you. There's an option on most beneficiary forms, often described with the Latin phrase per stirps. That means if one of your children passes away before you do, that child's share automatically flows down to their children, your grandchildren, instead of being redistributed to your other kids. If keeping each branch of the family whole matters to you, ask the custodian how to designate it that way. It's a small box that prevents a big future conflict. Step 4. Keep it updated forever. A beneficiary designation is not a set it and forget it. Every major life event, a marriage, a divorce, a death, a new grandchild, a falling out, a reconciliation, is a signal to pull out these forms and check them. Robert's entire tragedy was a failure of Step 4. Make it a habit to review your beneficiaries every couple of years the way you check the batteries in a smoke detector. Now, if you do those things, you've solved the Robert problem. The right people will inherit. But I promised you there's a second half to this, and it's the half that even careful people miss. Because it's not about who inherits, it's about how much of it survives the tax collector. Naming the right beneficiary gets the money to the right person. Understanding the inheritance rules is what protects how much of it they actually keep. And these rules change dramatically, so let me walk you through them, because this is where fortunes are lost to taxes. The single most important distinction is this. Is the beneficiary your spouse, or is it someone else, like your adult children? Because the rules for those two groups are worlds apart. Let me start with the spouse, because a surviving spouse has a superpower that no one else gets. When you name your spouse as the direct beneficiary of your IRA or 401k, they have the option to do something called a spousal rollover. That means they can take your retirement account and roll it into their own IRA, treating it exactly as if it had always been theirs. This is enormously valuable. It lets the money keep growing tax-deferred, it lets them delay taking withdrawals until their own required age, and it lets them stretch those withdrawals over their entire remaining lifetime, keeping the tax bite small each year. This is the gentlest, most tax-friendly way to inherit a retirement account that exists, and it's available only to a spouse, and generally only when the spouse is named directly on the beneficiary form. This is a huge reason to name your spouse directly. rather than routing the account through your will or your estate. And here's a useful wrinkle worth knowing. A workplace 401k and an IRA don't play by the same rules on this. With most 401k plans, federal law actually protects the spouse. Your husband or wife is automatically the beneficiary, and you generally can't name someone else unless your spouse signs a formal written waiver giving up that right. An IRA has no such protection. You can name anyone you want on an IRA form, with no spousal sign-off at all. That difference matters in two ways. In a first marriage, the 401k rule is a helpful safety net. But when someone rolls an old 401k into an IRA, which people do all the time, that automatic spousal protection disappears, and the account is now only as safe as whatever's typed on the IRA beneficiary form. So if you've been rolling old retirement plans into IRAs, that's one more reason to check those forms with your own eyes. Now here's where it gets serious, and where a lot of families are getting an unpleasant surprise. What happens when someone other than a spouse inherits, most commonly your adult children? There used to be something wonderful called the stretch IRA. When your kids inherited your IRA, they could stretch the withdrawals and the taxes out over their own long life expectancy, taking a little each year for decades, letting the rest grow. It was a beautiful, tax-efficient way to pass wealth down. But a law called the Secure Act ended that for most non-spouse heirs, and here is the rule now in 2026 that you must understand. When your adult child inherits your traditional IRA or 401k, they generally have to empty the entire account within 10 years. It's called the 10-year rule. And think about what that does. Say you leave a $700,000 traditional IRA to your daughter, who's 55 and at the peak of her career, in her highest earning, highest tax years. Under the old rules, she could have sipped from it slowly for 30 years. Under the 10-year rule, she has to pull all $700,000 out within a decade, and every dollar of a traditional IRA is taxable income when it comes out. So she's forced to stack $100,000 or so of extra income on top of her already high salary year after year, pushing her into higher tax brackets and handing a shocking share of your life savings to the IRS. Money you spent 40 years carefully building can get partially gutted by taxes in a way that would have been completely avoidable. Let me put rough numbers on it so you can feel the difference. Say your daughter earns $120,000 a year and inherits that $700,000 traditional IRA. Under the 10-year rule, to empty it, she pulls out roughly $70,000 a year on average. Stacked on top of her salary, much of that lands in a high tax bracket, so she could easily lose $200,000 or more of that inheritance to federal and state taxes over the decade. Now compare two other paths. If the old stretch rule still applied, she could have taken tiny withdrawals over 30 years, staying in low brackets and keeping far more of it. And if you had converted that IRA to a Roth during your lifetime, paying the tax at your rate, which in retirement is often lower than her working years rate, she'd inherit a Roth, empty it over 10 years, and pay zero tax on every dollar. Same $700,000, three completely different outcomes. One where the IRS takes a huge bite, one where it takes a small one, and one where it takes nothing. The difference between them isn't luck, it's planning you do now, while you're alive. And there's a further wrinkle the IRS finalized recently that catches people. If you had already started taking your required minimum distributions before you died, meaning you were past your RMD age, then your children not only have to empty the account within 10 years, they also have to take a mandatory withdrawal every single year. Along the way, they can't just wait until year 10. So it's a forced taxable drawdown on a schedule. Now, there are a few exceptions. The law calls them eligible designated beneficiaries, who escape the 10-year rule and can still stretch. That includes your spouse, a minor child of yours until they reach adulthood, a beneficiary who is disabled or chronically ill, and anyone who's less than 10 years younger than you, like a sibling. But for the typical case, leaving your IRA to healthy adult children, the 10-year rule and its tax squeeze apply. So you need to plan for it. Let me give you a few quick situations so you can find yours. If you're married and your spouse is your beneficiary, good. That's the spousal rollover superpower. Just confirm their name directly, not through your estate. If you're single or widowed and leaving accounts to adult children, you're squarely in 10-year rule territory. So the Roth conversion conversation is for you. If you're in a second marriage with children from a first marriage, this is the most dangerous situation of all, because naming your current spouse means your kids may get nothing, and naming your kids may leave your spouse short. This is exactly where you need a professional and possibly a special kind of trust, and exactly the mix that created Robert's disaster. If you have a loved one with special needs, do not name them directly, full stop. You need a special needs trust. And if you ever named my estate as the beneficiary, or left the form blank, fix that immediately, because routing a retirement account through your estate is close to the worst outcome. It forces probate and usually the fastest, most brutal payout schedule of all. Find yourself in one of those, and you'll know which move is yours. So what actually protects the money from that tax hit? Let me give you the real strategies, the ones that go beyond just naming a beneficiary. The first and most powerful is the Roth conversion, which we've talked about on this channel. Here's why it's so relevant to inheritance. If you convert some of your traditional IRA to a Roth during your lifetime, paying the tax now at your rates, then when your children inherit that Roth, they still have to empty it within 10 years. But every dollar comes out completely tax-free. You essentially prepay the tax at your rate, which is often lower than your working children's rate, and you hand them a tax-free inheritance instead of a tax bomb. For people whose kids are high earners, converting to a Roth over time can be one of the greatest gifts you leave them. You're choosing to pay the tax yourself so they don't have to, at a worse rate. The second strategy is simply being strategic about which heirs get which accounts. If you're leaving money to charity as well as to your kids, leave the traditional taxable IRA money to the charity, which pays no tax on it, and leave your tax-free assets, like a Roth or life insurance, to your children. Matching the right asset to the right heir can save your family a fortune. And the third involves trusts, for people with special situations, and this is where your will and estate plan reconnect with your retirement accounts. Normally you name a person directly, but sometimes you want more control. If a beneficiary is a minor, or is bad with money, or has a disability, in those cases you can name a specially designed trust as the beneficiary of your IRA. But, and this is critical, this is expert territory, because if the trust isn't drafted exactly right, in what's called a see-through form, it can actually trigger the worst possible tax treatment, forcing the account to be emptied even faster. So if you have a beneficiary who can't inherit a large sum directly, you absolutely need an estate attorney who specializes in retirement accounts to set this up. Do not do this one yourself. And let me flag that special situation specifically, because it's so important. If you have a child or grandchild with a disability who receives government benefits like Medicaid or SSI, never name them directly as a beneficiary of your retirement account. A sudden inheritance can disqualify them from the benefits they depend on. That's exactly what a special needs trust is for. But again, this requires a professional to set up correctly. Now, I don't want to leave you thinking your will is worthless. It absolutely is not. The point isn't that the will doesn't matter. It's that the will and the beneficiary forms each control different things, and they have to agree with each other. Your will still governs your house, your car, your belongings, your ordinary bank accounts, and it still names your executor and any guardians. Your beneficiary forms govern the retirement accounts, the life insurance, the annuities. The danger is when the two contradict, when your will leaves everything equally to the kids, but your IRA form names only one of them, or names an X. Then you've built a contradiction into your own plan, and the beneficiary form wins, and the family fights about the unfairness for years. So the goal is coordination. Sit down and make sure your will, your beneficiary designations, and any trust all tell the same story and point the same direction. When an estate attorney builds a plan, that coordination is half of what you're paying for. Let me also name the 4 mistakes that cause the most damage here, because avoiding them is most of the battle. Mistake 1 is Robert's, never updating a beneficiary form so an ex-spouse or a deceased person inherits. Mistake 2, leaving the contingent beneficiary blank so the account crashes into your estate when your first choice is gone. Mistake 3, naming your estate or your will as the beneficiary on purpose, thinking it gives you control. It does the opposite, forcing probate and the worst tax timeline. And mistake 4, naming a child directly when you should have used a trust, a minor, a disabled loved one, or someone who can't manage a large sum. Steer around those four, and you've protected the largest money you own. So, let me pull this all together, because it's a lot, and I want you to leave with the clear version. The big idea: your will does not control your retirement accounts, your life insurance, or your other beneficiary-designated assets, and those are usually your biggest assets. What controls them is the beneficiary form on each account. So first, you protect who inherits. Check every account, name a primary and a contingent beneficiary, keep them current forever, and understand that this form overrides your will. That solves the Robert and Linda catastrophe. Then, you protect how much they keep. Name your spouse directly, so they get the spousal rollover. Understand that your adult children face the 10-year rule and its tax squeeze. And consider Roth conversions during your lifetime to hand them a tax-free inheritance instead of a taxable one. And for any tricky beneficiary, a minor, a disabled loved one, someone who can't handle money, get an estate attorney to build the right kind of trust. Because doing it wrong is worse than doing nothing. Now let me be honest and careful with you, the way I always try to be. I am not an attorney or a tax advisor, and none of this is personalized advice. These inherited account rules are genuinely some of the most complicated in the entire tax code. The 10-year rule, the exceptions, the trust mechanics, whether annual withdrawals are required, and the details depend on your exact situation and can change. The figures and rules I've described are current for 2026, but this is precisely the kind of area where you want a professional. Specifically, for anything involving trusts as beneficiaries or a Roth conversion strategy, sit down with an estate planning attorney and a tax professional together. This is some of the highest value professional advice you can buy because the sums at stake, your entire retirement savings, are so large, and the mistakes, as Robert's family learned, are so permanent and so unfixable. Let me leave you with this. We started with Robert, whose will left everything to the wife he loved, and whose largest account went to an ex-wife he'd divorced decades earlier, because of one form he never checked. That is the danger of not understanding this. But flip it around, and you see the opportunity. The very fact that these accounts pass outside your will, directly and instantly by that beneficiary form, makes them the simplest assets in the world to protect. No probate, no court, no delay. The money going exactly where you point it, fast and private. All you have to do is point it correctly and keep pointing it correctly, and understand the rules so the tax collector doesn't take more than they should. So, here is your one assignment this week, and it might be the most valuable hour you spend on your finances all year. Pull up every retirement account and every insurance policy you own, and look at the beneficiaries with your own eyes. Confirm the primary is who you want. Confirm there's a contingent named. Fix anything that's wrong or out of date. It costs you nothing but an hour, and it protects the largest money you have from the single most common, most heartbreaking, most preventable mistake in this entire subject. Your will has been getting all the attention. It's these forms, working out of sight, that decide where most of your fortune actually goes. So go make sure they're pointed at the people you love.